AI chips are growing at 170% year over year, and data center footprints are doubling every 3 years. And hyperscalers like Microsoft and Google are pouring hundreds of billions into AI infrastructure. But here's what no one wants to talk about. Every one of those GPU clusters is about to hit a wall, because the real bottleneck isn't the silicon. It's electricity. By 2030, US data centers alone will consume 1,200 terawatt hours a year. That's enough to power every American home twice over. Think about it. That's like building 30 Hoover dams every single year just to feed those servers. Globally, the IEA projects demand jumping from 415 terawatts today to nearly 1,000 by 2030. Push that into 2035, and you're looking at over 3,000 terawatt hours. And that's before the next generation of AI training even comes online. This next decade will be defined not by who makes the fastest chip, but by who controls the power that keeps those chips running. And that's why today I'm going to break down the nuclear stack, from uranium mines to fuel fabrication to reactor builders. I'm going to show you which companies own the leverage at each one of those steps. We'll walk through all 4 tiers. It's going to be the miners, the fuel manufacturers, the innovation startups that are racing to deploy next-gen reactors, and the proven utilities that are already operating gigawatts and partnering with hyperscalers. Because the real opportunity isn't just picking one of those layers. It's understanding how they all interconnect and balancing both the moonshots and the cash flow. Then, of course, at the end, I'm going to walk through exactly how I would invest $100 if I were starting from scratch. Because the AI backbone is already being built by the companies you're about to meet. And just as an example, a modern AI training campus can draw hundreds of megawatts around the clock. In fact, Meta is building one site with 5 gigawatts of capacity. That's more power than the Diablo Canyon's 2.2 gigawatts. Now, that's California's last operating nuclear plant, dedicated entirely to servers. And once AI models go live, they never sleep. That's called Inference Load, and that's the constant draw from every AI call happening in your phone, your search, and even in your car. It's literally turned AI into a 24/7 baseload industry, but the grid wasn't built for this, and renewables can't run around the clock, and gas blows the carbon budgets that every corporation had already promised. That leaves exactly one option: baseload power that's zero carbon, always on, and scalable. It's nuclear. And if nuclear just captures 30% of this new demand, it opens a 60 to 90 billion annual market by 2035, effectively doubling the entire industry. And that's what makes this the real story. AI simply can't expand another decade without a new energy backbone. And the companies building that backbone, the miners, the fuel fabricators, the reactor builders, they're going to decide how far AI can actually go. Now, if you're new to the channel, you may have missed my first nuclear stock video last year, where one of my top stocks that I bought at that time was OKLO, which is now up over 500% year to date. And of course, you can see my entire portfolio in my free newsletter with a link down below. And if you happen to be getting any value from my educational videos and my spreadsheets, please consider pressing the like button so my channel can continue to grow. It happens to be 4 connected tiers, and each one depends on the layer below it. Tier 1 is mining and feedstock. It's raw uranium ore pulled from the ground, converted into yellow cake. Tier 2, fuel and enrichment. This is where raw ore becomes usable reactor fuel, enriched into low-enriched uranium and increasing HALEU. That's high-assay low-enriched uranium, the grade that's required for those next-gen small modular reactors, or SMRs. Tier 3 innovation reactors. These are the startups that are trying to turn nuclear from 15-year megaprojects into 3-year factories. They're designing smaller modular reactors that can sit right next to industrial plants or right behind the data centers. These happen to be high risk, high reward, and these companies are burning through their cash today, and they're betting on regulatory approval and first-of-a-kind deployments. Then we have Tier 4, operating utilities. These are the established giants that are already running massive nuclear fleets. They're not speculative, they're actually profitable, and they're dividend paying and now expanding into SMRs to meet that AI power demand. And that's where this innovation starts to meet the execution, and that's where moonshots actually meet the cash flow. But here's what really matters. Demand isn't capped by the regulation anymore. It's capped by the fuel supply. We happen to have the need and we have the capital, but without enough HALEU capacity, those reactors can't even break ground. Now, let's walk through it layer by layer. We'll start at the bottom. That's the uranium miners. Global uranium demand sits at around 180 million pounds a year. But the supply? Well, that happens to be closer to 140 million. And that 40 million pound deficit, it's being filled from inventories that are shrinking very fast. New production isn't even optional. It's urgent. Our first company is Uranium Energy Corp. They own fully permitted, shovel-ready projects in Texas and in Wyoming, assets they acquired from Rio Tinto and Uranium One Americas when prices were extremely low. The key is in situ recovery mining. They inject a solution underground, then they extract the uranium-rich fluid, and they process it without ever moving millions of tons of rock. This is good because this means that they can restart the production within months, not years. Once, of course, the uranium prices justify it. They're also delivering directly into U.S. government stockpile programs under the Department of Energy contracts. In a market where domestic supply is a national security priority, UEC has the permits, the infrastructure, and the political tailwind. Next up is NextGen Energy. Their Arrow deposit in Saskatchewan's Athabasca Basin contains some of the highest grade uranium on Earth, averaging over 4% compared to a global average of a 0.2%. That grade advantage translates directly to economics. You're going to have lower mining costs per pound, smaller physical footprint, and less waste. They've already completed a full feasibility study showing that the production costs under $10 a pound, and they've already secured agreements with local First Nations communities, which are critical for permitting in Canada. Once financed and built, Arrow could produce 29 million pounds annually, roughly 10% of the global mine supply from a single site. Now, there are some of these companies that are gaining from this nuclear boom, but with less risk. And that's where today's sponsor, Uranium Royalty Corp, comes into play, where they are a pioneer in the uranium sector. And with a majority of all uranium being imported to the US, UROY is uniquely positioned to benefit from the global resurgence of nuclear energy, but with a unique take on it. UROY is bypassing the operational hassles and the risks of traditional mining. Instead, they utilize an innovative business model that focuses entirely on royalties and streaming deals. This unique structure provides investors with exposure to the uranium production, which I've already called out as a bottleneck in this nuclear stack, but without the operational challenges. This low-risk approach is particularly significant because it allows them to sidestep major regulatory friction. For example, the Nuclear Regulatory Commission's process for a single reactor design once cost $500 million, and it required a staggering 12,000-page application. By focusing just on the royalties, UROY offers investors a low-risk way to gain from rising uranium prices. And it's showing in their stock, where they're already up over 160% in the past 6 months. UROY provides exposure to production from a diversified portfolio of 19 projects globally. They also leverage strategic partnerships with leading companies like Yellowcake plc, providing direct access to physical uranium. This strategy, which mitigates traditional mining risk while securing high-value opportunities, makes UROY a compelling standout investment opportunity in this uranium sector. If you'd like to learn more about UROY, please check them out down in the description below. The third miner on our list is Energy Fuels, and they own White Mesa Mill in Utah, the only conventional uranium mill operating in the United States. It's licensed to process uranium from third-party mines and permitted to handle rare earth elements, making it a dual-use strategic asset. In fact, they've already sold uranium into DOE's newly established Uranium Reserve Program, and they're positioned as the primary U.S. converter for government and utility customers that are looking to avoid that Russian supply chain. White Mesa gives them optionality that pure miners just don't have. Next is Cameco Corporation, the heavyweight of the uranium world. Cameco is the second largest publicly traded uranium producer globally, operating in Canada and Kazakhstan. Unlike the others, they're already producing at scale. Their Cigar Lake mine is one of the world's highest grade uranium operations, and they control about 15% of global production. They also own some of Westinghouse Electric, giving them exposure across the entire fuel cycle. The trade-off? At over 20 billion market cap, they're priced for stability, not really for explosive growth. But if you want uranium exposure without development risk, Cameco is the blue chip play. Now, overall, these four miners form the foundation of the supply chain. Without new feedstock, the entire fuel cycle is going to stall. That's why the miners are the first domino. So as I said, mining is the foundation, and fuel and enrichment, well, they happen to be the choke point, because you can dig up all the uranium that you want, but until it's enriched into reactor-grade fuel, it's just a rock. And here's where the problem sets in. About 45% of the world's enriched uranium still comes from Russian facilities. And that happens to be the single biggest vulnerability in the clean energy transition. So the companies that are rebuilding that capacity aren't just suppliers. They're really the gatekeepers. First is Centrus Energy, and they happen to be the only U.S. company licensed to produce HALEU, high-assay low-enriched uranium, as a reminder. Now, standard commercial reactors use uranium enriched at about 5% of the U-235. HALEU, on the other hand, runs up to 19.75%, so it's more power per unit. It's a smaller reactor footprint, but a much higher efficiency. And it happens to be the fuel that next-gen small modular reactors are going to require. Centrus has its first cascade of centrifuges running on the DOE's Piketon, Ohio facility, producing HALEU for the DOE's test reactors. Nobody else in North America can do this. The first commercial batch came off the line in late 2023. By 2025, they were planning to scale to 6 metric tons of HALEU annually, enough to fuel several small modular reactors. And the DOE has earmarked hundreds of millions in funding for this supply chain rebuild, and Centrus happens to be at the very center of this. Because without them, none of the SMRs from OKLO, NuScale, or the utilities can even start. So once again, it's a single point failure and single point leverage. Now we'll move on to our second fuel company, which is BWX Technologies. So if Centrus makes the enriched fuel, BWX turns it into usable reactor cores. They fabricate nuclear components for both the US military and the private sector, including TRISO fuel. Each TRISO pellet is a uranium kernel wrapped in carbon and ceramic that can withstand extreme heat without ever melting down. And BWX is under contract with the DOE and Department of Defense to produce TRISO fuel at its Lynchburg, Virginia facility, one of the few sites in the world that are qualified to do it. Defense contracts fund the R&D, but the commercial side, well, it's just beginning. Those same TRISO pellets that are going to power microreactors, and they're aimed at industrial campuses, AI data centers, and of course, remote infrastructure. And they also run component manufacturing for submarines, naval reactors, and those upcoming SMR projects. Centrus is pure fuel. BWX is fuel plus fabrication plus recurring revenue. Together, they form the bridge between uranium and electricity, and they happen to be the fulcrum of the next nuclear build-out. The overall constraint isn't natural, it's human-made. You can't open a new enrichment facility in 18 months, just like you can't fake nuclear-grade certifications. In this case, the moat happens to be time, and that's the most valuable moat of them all. Now we'll move on to the hardware layer, which is the reactors. So all the uranium and HALEU fuel in the world doesn't exactly matter unless someone builds reactors that actually turn it into power. And this is where nuclear finally starts acting like tech. And these are the moonshots, or the companies that are betting everything on breakthrough designs. Once again, they're high risk, they're high reward. And of course, they're burning through cash and they're waiting for a lot of the regulatory approval. And if they execute, the returns could be extreme. But if they fail, of course, as always, it could go to zero. Now, first up in the innovation reactor tier is OKLO. They're a micro-reactor company backed by OpenAI's Sam Altman. Their Aurora design produces about 15 megawatts of continuous power, enough to run a large AI data center. They're built to operate for 10 years without ever refueling. No moving parts, no water-cooled core, minimal waste. So what exactly makes OKLO different? They don't want to sell reactors. They want to own and operate them, like mini power plants. Instead of relying on utilities, they're targeting private customers, industrial campuses, defense bases, and hyperscalers that really want to lock in that 24/7 clean power. They've already received conditional site use permit from the DOE at Idaho National Lab, and they're targeting their first operational reactor by 2027. Now, if they pull this off, OKLO becomes the template for nuclear as a service. Now we'll move on to our next company, which is NuScale Power, and they are the heavyweight of the small modular reactor world. In 2023, they became the first and only SMR design fully approved by the US Nuclear Regulatory Commission. Now, of all the moats, that is a massive regulatory moat. Their modules produce 77 megawatts each. You can cluster up a dozen for nearly a gigawatt. And unlike traditional reactors that take 10 to 15 years to build, NuScale's system can be factory produced, shipped by rail, and installed in under 4 years. Their first project, called Voyager, is being developed with Utah Associated Municipal Power Systems backed by the DOE. They're also exploring deployments in Eastern Europe, where energy security is the top priority. Now, every single one of those SMRs are going to need HALEU fuel, the same kind that Centrus is producing. Tier 2 and Tier 3 really move in lockstep. Now let's shift gears completely. From the startups that are burning cash to the utilities that are already making it. This tier isn't about regulatory risk or unproven designs. It's about established companies with decades of nuclear operations, extended reactor licenses, and now partnerships with hyperscalers to deploy the next generation of SMRs. Next, we have Dominion Energy, which operates 3 major nuclear plants across Virginia and Connecticut, providing reliable zero-carbon baseload to more than 2 million homes. They've already extended those reactor licenses into the 2060s, locking in decades of operating runway. But here's where it gets a little interesting. Dominion just signed a deal with Amazon to explore deploying small modular reactors in Virginia, the first hyperscaler utility nuclear partnership on record. It's the clearest signal yet that AI-powered demand is pulling utilities straight into the SMR era. Now, what I like here is Dominion isn't speculative. It's already cash flow positive, they're dividend paying, and they already are nuclear heavy. So in this stack, it's the stability anchor. Baseload that you can already bank on. Right alongside Dominion sits Duke Energy, the quiet giant of the American nuclear. They operate 11 nuclear units across 6 sites in the Carolinas, totaling over 10,000 megawatts of generation. That's roughly 1/10 of the entire US nuclear fleet, all under one balance sheet. Duke recently extended its Oconee nuclear station through the 2050s, and its 2025 resource plan includes new reactors and SMRs to meet that data center and AI demand across the Southeast. Once again, this is not theory. It's actually operating baseload with expansion potential. In a portfolio built for the long game, Duke is the income engine. It's regulated, reliable, and it's ready to scale nuclear again. So together, Duke and Dominion, well, they really represent the proven half of the nuclear stack. While OKLO and NuScale chase breakthrough designs, and they're burning through all their capital, while these two are already generating gigawatts, and they're paying their shareholders while they expand. And just like the innovation plays, both of them depend entirely on the 2 tiers below them. Because without HALEU from Centrus and BWX, these new SMRs can't even start. And without the feedstock from the miners, well, there's nothing to enrich. That's why this is a 4-tier stack. Each of these layers is going to need the one below them in order to work. So the big question is, how do you actually invest in this? Well, let me preface this with the fact that most all of these companies have extremely high valuations and poor fundamentals. Most of them had been ignored for years and only recently had been given the spotlight. I don't intend to invest in any of these in the short term because the technicals are pointing to the fact that most of these are going to have corrections either while I'm making this video or in the next several months. And I think that's when the real opportunity is going to show itself. So when that time does come, this is how I would list out how I would invest that $100 at that time. I would treat it like a portfolio across all 4 tiers. Once again, the mining feeds the fuel, fuel feeds the reactors, and reactors feed the AI grid. If one link is going to break, then the whole chain is just going to slow down. But here's the key. Not all tiers deserve equal weight. The innovation plays in the tier 3 are very high risk, and of course they're high reward. Many of these are going to fail, and they're kind of like lottery tickets. The operating utilities in the tier 4, well, they're cash flow positive today, paying dividends, and they're already partnering with hyperscalers. And it's true, they have much lower upside, but they have far higher probability of having success. So for me, I would be weighting this for risk-adjusted returns, not just maximum upside. So in Tier 4, I'd have roughly 35% because it's the stability anchor. It's already got cash flow, dividends, and proven execution. Duke Energy for scale because operating 10% of the entire US nuclear fleet. Then you have Dominion Energy for the Amazon SMR partnership. These aren't just baseload plays, they're income engines that pay you while they expand. Next is Tier 2, the fuel and the enrichment, which I place roughly 30% because this is the bottleneck. This is where the leverage really sits. Centrus Energy, the only HALEU producer in North America. BWXT Technologies, fabrication, defense contracts, recurring revenue, because you can control the fuel, you control the rollout speed. And then I'd focus on Tier 1, which is the mining and the feedstock at about 20%, because the supply is the foundation. Cameco for the blue chip anchor, the world's second largest producer, and then Uranium Energy Corp for the shovel-ready US projects and the government contracts. And then NextGen Energy for the highest grade uranium deposit on Earth. And last is Energy Fuels for the only operating uranium mill in the United States. Then I'd move on to Tier 3, which is the innovation reactors at 15% of my total chunk, because this is the moonshot allocation. Once again, it's high risk and extreme upside. NuScale for proven regulatory approval, the first and only NRC approved SMR design. OKLO for the microreactor bet that's backed by Sam Altman and OpenAI. This is the smallest allocation because most first-of-a-kind reactor projects tend to fail. But once again, if they execute, this 15% could become the highest returning piece of this entire portfolio. At the end of the day, this isn't equal weighted. It's risk weighted. You're putting the most capital where the probability of success is the highest, in operating utilities already generating revenue and they're paying dividends. That's my approach. Yours might be different. I'm really trying to keep meaningful exposure to the bottleneck, and that's the fuel and the enrichment, because that's where the pricing power really sits. In this way, I'm trying to cover the foundation with miners who supply the whole feedstock, and I'm keeping just enough in the moonshots to capture outsized gains if they execute. Once again, this is a 4-tier stack, balanced for both growth and stability. And of course, for those of you who prefer simpler exposure, uranium ETFs like URNM or URA can replace the individual mining stocks. And you can see that they've already had solid returns year to date. Now let's take a step back and look at the 10-year outlook, which I think is pretty straightforward. If AI power demand grows even half as fast as projected, nuclear demand will still double by 2035. Fuel and enrichment could 3 to 5x as capacity tightens. The tightest bottleneck tends to get the biggest multiples. And as for innovation reactors, the Tier 3, they could 5 to 10x if they execute. Or once again, they could go to 0 if they fail, because it's high risk, extreme upside. Then we have the operating utilities, which is the Tier 4, and they could 2 to 3x on SMR expansion plus the dividend reinvestment, because these are very much lower risk and steadier returns. And then we have mining, which could 2 to 3x from higher uranium prices and the supply constraints that we already know exist. So my expectation on my $100 invested should be closer to $300 to $600 in 10 years, all depending on execution. This isn't just a simple trade. In my mind, it's a 10-year thesis with both high-risk moonshots and a really stable income anchor. And I feel that the 4-tier stack ensures that we're covering every dependency layer from the dirt to the electrons. Because you have to admit that in 10 years from now, every AI data center is going to owe its uptime to a handful of companies that most investors are overlooking today. As always, thank you so much for watching.